Nirav, the sands are shifting a little bit on the equity landscape. I would love to understand from you how you're thinking about it. So Jerome Powell indicating towards the top in the dollar index, and we are also seeing China unequivocally saying that even if cases are going to move up, we are still going to continue reopening. How does this augur for the change of preference of order for world markets?
Well, so I think, firstly, these are all important factors, but very technical in nature, the way I look at it. Neeraj, the big thing is that we have to put India now in a global context and where are we and what is our ranking and what does India offer? And then we'll come to these things. So if you now try and segregate India in terms of the top 10 market capitalizations in the world, we are at roughly about number 6 with close to about $4 trillion of market cap. So there are 5 countries ahead of us, and there are 3 countries below us. The 5 countries that are ahead of us, on an average, will grow their nominal GDP by about 2.7% over the next 2 years. Ex-China, that growth rate falls to 1.7%. Now I'm looking at 3 countries that are beneath me. They are going to grow at about close to 2.9% over the next 2 years. And even if you build in a lot of pessimistic scenario, India will grow at roughly about 6.8% in the current year, and depending upon the economy's expectations, will grow at 6% not in next year, for several years, right? So if India doesn't do anything dramatic, it will grow at 6 and 7% for a long period of time, and we are talking about a $4 trillion economy. Out of the 10 countries that I referred to, 3 of them are autocratic countries, right? So now we have to give a premium to the fact that you got a very robust democracy and rules of law, properties, and rights. Now let's come back to the technical factors. So I'm saying that is a big picture that you got in India, right? And now we come to technical factors. So China, obviously, the fact of the matter is that we always believe that reopening had to happen, right? The question is that they have to choose the time of reopening. It seems that this has been forced onto them, and that introduces an element of risk, because we don't know the pace of the infections. We don't know whether infrastructure is geared up to, in terms of hospitals and vaccination and stuff like that, whether it is geared up to handle that. But that is something that we'll know in the next 2 weeks or 3 weeks. At best, what we can do, we can suppress the demand, right? So there is a hope that China comes back, and obviously, if there are pains in terms of reopening, it will start impacting the aggregate demand and stuff like that. But even that is deflationary, right? So the broader picture that I look at is that inflation is out of the window. Goods inflation is collapsing. There is no doubt about it, and we should only look at leading indicators. And this is exactly what the bonds are telling you, right? That so, and then service inflation. I don't want to get too much into the service inflation, but suffice to say that in massively capitalist economies, it is unlikely to have a wage price spiral, right? Because your unionized labor is just 9%. It was 33% in 1980. So I don't even compare that template. So in our frame of reference, we are done with the inflation. We don't know. What we don't know is that the lagged impact of monetary policy and what happens to the global growth, and within that context, what happens to India through the export channel. That we don't know. But you never know anything about the markets or the economy at any point of time, right? So a lot of things you'll know, a lot of things you'll not know in terms of probability. But we are in a good place. The only thing that we don't like, which is why the markets will not correct, is valuations, right? So no one tells you that you have to buy cheap because you make more return. Life doesn't work that way. Markets don't work that way.